Welcome to the Deal Insider podcast. I'm sitting here with Greg Gilliland, the CEO of the Crafty Elk. Greg, thanks for joining us today. Appreciate
Thanks,
you
Mass.
taking out the time to speak to us today.
Yeah, no, for sure. Thanks for taking the time. You're looking
Okay,
great.
great. So, Crafty Elk, it's a very interesting brand. Give us some color on it.
Yeah, sure. So Crafty Elk's been going for about 8 years, federally incorporated company in Canada with a subsidiary in Austin, Texas called the Hard Juice Cocktail Co. We're essentially on a mission to disrupt a $200 billion ready-to-drink market currently right now that we believe is littered with artificial preservatives, sweeteners, colors, dyes. And my background's in pharmaceutical science, so I kind of see the stuff from a mile away. And even probably people don't know this, but some of the top leading seltzer brands out there have used or formulated or basically contracted to make alcohol with sucralose and aspartame. So artificial sweeteners are driving the enzymes artificially to make a cheaper form of alcohol. So at Crafty Elk, kind of our mission and vision is to make cleaner, better for you cocktails that not only feel good but taste great too. And part of the reason why a consumer would believe that is that when you actually take a taste of one, you don't taste all the artificial sweeteners. It's not a high carbonation hit. All of our ingredients are organically sourced. Our vodka is from Piedmont, Italy. Basically, I formulated these with vegetable pulps, juices, a Piedmont Italian vodka, and we have turmeric, goji berries, prickly pear, and ginger, which if you go on Google and check them out, they all have great attributes, but you'll notice they're natural plant anti-inflammatories. So we make socially feel-good cocktails.
Right. The Now, are you guys primarily just based in Canada, or where else can we get the Crafty Elk?
Currently, right now, we've been selling in Ontario for a duration of 8 years.
Mhm.
Most people don't know this, and I didn't know it at the start. Ontario is one of the most difficult markets to navigate an alcohol. One, it's run by government. Anytime you get involved in government, it does become difficult. But we've been successful over 8 years in navigating the market. We have basically carved out our own distillery license, our own sales agency. We currently run 8 warehouses. We distribute nationally across Ontario, which is not easily to do. And we really did this by avoiding going into the big government warehouse where you can kind of really get tied up and kind of lose sight of where your brand's going. And we just stayed really tight in the pocket with on-premise restaurants. And what's remarkable about it is that when you look at a CPG company and you look at their financial performance or you look at their balance sheet, usually 90% of their revenue is coming from the off trade. So the retail stores, grocery stores, hypermarkets, etc. The on premise is 10%, which is your restaurant and bar. So on premise is basically your props on the stage. Your main actors are obviously the retail stores. This brand currently, right now, for the last 8 years, has only been selling into restaurants. So you're only seeing 10% of its potential, yet it's still doing 15,000 cases and it's still doing $800,000 a year. This year, we're 154% above where we were last year, just literally 10 weeks into our season. And the reason that is because Premier Ford in Ontario changed the legislation over. He's basically broke the beer store LCBO contract. So most people don't know this. So what does Ontario look like? Well, previous to the Premier doing this, Ontario was 644 LCBO stores and 400 convenience stores, which we could not sell into. We only had that restaurant channel. But now that he's broken that, you're going to see in the new year, we're going to have 3,000 grocery stores and 8,000 convenience stores to go into. So just us getting into 24 convenience stores, and we're selling up with all the big brands. We're not doing any marketing, no in-store tastings. We managed to sell 3,000 cases in 8 weeks. So that's the repeat purchase pattern and velocity that we see down in the coal face that we're experiencing on our balance sheet. And obviously, I'm happy to share all that with you.
Great. So moving forward, obviously, you're in the Ontario market. What are other markets that you're looking to tap into, down the line?
Yeah, sure. So some of the excitement that we've had most recently within the last 2, 3 weeks, which is quite fresh and new, we've held meetings with the British Columbia Liquor Distribution Branch. They basically are in full support. To see us there, they're looking at listing 2 SKUs. So when you look at the BC market, there's 699 private liquor retail stores out there, and then you have 200 government stores. So the conversations we've had around is the government stores, which are a little bit harder to get into, but with it, the private liquor retail stores feed a lot off that and buy a lot off that. Keeping in mind, British Columbia is the highest consumer in Canada of organics. It's also the highest consumer of RTD on a per capita basis. So ready to drink cocktails. And the reason that drives that in BC, if you've never been there, camping, canoeing, skiing, snowboarding, outdoors, mountains, got to live life, not sitting at home watching the TV. These are active shoppers that are in the know in their fitness. They take a look at a can, they take a look at a product. They're very smart shoppers. You don't have to put much marketing effort into them to convert them over to an organic. They already know. As well, we've held talks with Loblaws Canada, which is one of the largest grocery store outlets in Canada. They're interested in the products for Alberta, Saskatchewan, Ontario. They have looked at the East Coast. However, that would involve a government store listing, and it's not really on a radar of the East Coast. So with Loblaws, that would be Alberta, Saskatchewan, Ontario. In Alberta, Loblaws represents 25% of the ready-to-drink category. So it's a nice way to get your foothold in there. They're a great outlet. All eyes are on Loblaws. They're big on their innovation. We've had positive talks with Sobeys as well, which is another grocery store outlet. This would be predominantly for Ontario, though. And one of the main points, Naz, we signed with the largest distributor, or one of the largest distributors on the East Coast. They're traditionally a beer distributor, but they nationally cover New York, New Jersey, Wisconsin, Rhode Island, Massachusetts. That's a nice portfolio to have, and so we're really excited by that. And we have held talks on the West Coast, but I have kind of pulled back on those talks just simply because we need the capital.
Got it. Being in such a competitive space, what do you think the biggest challenges have been thus far in terms of growing this brand?
Well, for us, the obvious answer that the early stage entrepreneur puts up their hand says, well, capital, right? To be able to hire resources and also to be able to do the marketing. But when you look at the market as a whole in the RTD category, it's very interesting. And it's a pattern that is really showing itself and is starting to resonate, is that if you look at 2015, that was the year that hard seltzer was first introduced into America. Its first year, don't quote me on it, but I think it was about a $16 million category. Today, it's a $14 billion category. Everybody along the way in 18, 19, 20, 21, first thing they were thinking is, Maz and Greg are going to launch an RTD. What are we going to call it? Well, it's polka dot, and it's going to be called hard seltzer. Like, everybody wanted to use that phrase. Now, what is a hard seltzer? And in my view, what we're seeing and what we see from the consumer reports, it's a form of a diet drink, where there will always be a spot and room for a diet drink. Just not everybody can be a diet drink. There's only so many Diet Cokes, only so many Diet Pepsis that are on that product. So what we actually saw in 2023, if you look at the American Euromonitor data, you saw the hard seltzer category fall by 3%. You saw whiskey grow by 30, you saw tequila grow by 33, and you saw canned craft cocktails grow by 38%. So what is happening at the consumer level? What are they saying? They're going in and they're going, hey, I used to buy 4 cases of White Claw back in 2018. It was pretty cool. It had a wave on it. I was into it. But I'm not going to spend my whole weekend on a diet. So what we're seeing now is consumers want more flavor. They're only buying maybe a 6-pack or a 12-pack of White Claw. Then they're buying a little bit of red wine, a little bit of beer, and something else. So we saw this pattern coming in about 2018, 19, and therefore we trademarked the category hard juice. So one of the pieces we believe that deviates us and gives us that Ferrari going 300 miles down the road in our own lane is the fact we're hard juice. There's not a lot of organic products out there, but where competition does steep is that you get out into a market, you start to get your spikes, you start to go, everybody talks and they think, hey, I'm a big distributor, I'm a big player. Maybe I'll just rip that drink off. Because at the end of the day, unfortunately, you can't patent beverages. You could. We could go spend 50 grand or 10 grand or 30 grand with the law firm and patent our drinks. And then somebody just changes them by, 20%, and then they come out. So it's not really a game you kind of want to get into. I hope that answers your question.
No, no, it does perfectly. So, obviously being let's just say, a cleaner version of what's out there, in terms of the ingredients and everything that you've described. Are there any other differentiators, compared to your brand compared to what's out in the market right now?
Well, I think the biggest thing that we got back from our customers in over 8 years of selling, because it isn't really our first rodeo. Um, Most people right now, we're competing against all the big guys. Like, I'll face it, we're in the stores, we're in the restaurants. Restaurants could easily choose a White Claw or a Truly or a Bon Avive, or a Happy Dad seltzer. Why aren't they carrying it? Because their consumers aren't necessarily calling for it. And some of these big brands can spend the money on the shelves and cater to the gondolas and the end caps and do their thing. But there's a lot of brands out there when you actually look at the velocity pull rate, they're not as high, they're not as good. So the number one thing that we get back from the coal face of the customer is when I drink Crafty Elk, I genuinely don't taste a chemical aftertaste. It feels good to me. It feels right. It's a drink I can socially enjoy with my friends. I can have two drinks and still drive and not have to feel like I had an 8 or 9% craft beer or one of these heavy drinks. And I'm going, am I going to blow over it? I don't have one of these manual breathalyzers necessarily in my car or so forth. So I really also think too is that it's kind of funny, like as brands mature almost in any sector, any category, eventually, they go from being a toddler, a teenager, an adult, they get gray hair on their boards, they start cutting their costs, they start bringing their stuff in, and there's this corporate stench that gets out on the street. And these big brands, they need to acquire new craft brands because they got to relinquish their relationships with the big auditoriums and the sports stadiums, because in some situations you have a dad who's 55 years old or 50 coming to the game with their 21-year-old son, and the son is all about craft. It's all about giving back to community. It's about Susan's smoking Skull craft beer he wants, and he goes up and it's like, well, we have Coors Light. It's like, well, I don't drink Coors. I'm not supporting the corporate greed, so I'm going back to my seat with the water, and you didn't get any money. So these companies, unfortunately, these CEOs got to keep relinquishing their portfolio. There's always this innovation that's going to keep coming. There's always this piece that's going to keep driving, and I think Crafty Elk's at the forefront of that.
Great. Now, you had also mentioned the need for additional capital. Obviously, I'm assuming to grow the company. What exactly is that capital going to be utilized for, and where does it take the Crafty Elk brand?
Yeah, so I'll just take you a little bit bottom up before I answer your question. So, funny enough, in the CPG space, the most expensive portion to any of these businesses, ironically, is the packaging. It almost accounts, by the time you put your chocolate bar or you put your drink into a can and package it all up in those nice corrugate trays that we see at the stores or at the grocery stores, you're almost at 60% of your costs there. The other 40% is your food or your ingredient that you put into your packaging. So when you look at a big CPG company, and I'll just name one, Pepsi, for instance, if we were looking at their pie graph of what they spend in a year, how they spend it, and this is a bit ignorant, I'm just going top down here. You would see inventory running at about 35% because their cost of goods are so low. They've got such high volume. Maybe by this point they have their own manufacturing. In Coke's case or Pepsi's case, yes. 50% of their money is out on the arsenal, buying those end caps, spending on marketing, 10% in sales, 5% in financial and legals. In Crafty Elk's case, when we raise this money, our portfolio would be 50% inventory, possibly a little bit of a line of credit through the bank as a just in case. We have one of those months where everybody went crazy and drank it and we stocked out. You've got 30% in marketing, you've got 15% sales, and then you've got 5% in legals. And so what's driving that? Well, our costs are going to be more because we don't have the millions of cases going out the door yet. But really, at the end of the day, where you look at when you see a company like Crafty Elk, like say we go down to New York tomorrow, we get into New York, we get some sales guys on the road. You're going to be in around a 43% margin versus in Ontario right now, we're in a 52 to 54% margin, depending on the flavor, because our blackberry juices cost a little bit more because the blackberries cost a little bit more, but we're in that 52 to 54. But where it all gets to, and the most critical part, and I see this with other CPG companies is you go in and you look at their financials. They don't have that goal or standard that they need to get to. And the standard is 60%. If you can't get to a 60% margin, you're in trouble because you need that money back into your cash flow to constantly be relinquishing the shelves. And so many times we see people come out and they go, I'm bringing out this new honey and it's got this really cool bee on the front. I'm going to put it on the shelf. My product is going to sell. It's going to be amazing. And it's like, well, if no one knows about it, then no, it could be the best honey in the world, but you will fail. It's it's like it's like YouTube versus Vimeo. Vimeo had the better technology, but YouTube went out and asked people to share. That was the difference. They engaged their fans. So when we look at marketing, you've got to watch the push pull. There has to be a push pull. And what the heck do I mean by that? Well, the push is you go sign on with a distributor, which we signed on the East Coast. The first conversation they had out of us was, hey, Greg, kind of want to understand who you are, your acumen. What do you expect out of us? I said, I expect you to warehouse my product and I expect you to drive it in a timely manner upon receipt of the purchase order to the store. And I expect you to put it in the back room. Oh, you don't want our sales guys? I said, I do want your sales guys, but I recognize that there's way too many big brands paying for your lights, your trucks, and your warehousing. You're not going to drop all them just to bring us on. So let us come in, do some heavy lifting at the start. Let our sales team come in and merchandise those shelves. Build the relationship with Shelly that stocks the shelf. Build the relationship with the managers. Do a tasting with them. Maybe give them a t-shirt. Take them out for a day to the Crafty Elk factory so they can see the stuff getting made. Go through all that because that's where the coal face is built. And if you look at like a company like High Noon, who's extremely successful, they're one of the top cocktail companies, probably a big competitor for Crafty Elk, the 21.5 million cases in. Why is it? Because they front loaded all their money into the sales force. Every day that distributor represents them, that sales force is sitting shotgun in their car, talking about High Noon, talking about the new formulas they're doing, giving them this, helping them with that. Can I move your beer out of the back for you? All those kind of things. So you've got to start with the push, and the push starts with your own sales reps. The number one assumption in our financial is the distributor will warehouse it. They will drop it off in the back room. That is it. The second piece is the marketing. So the marketing for us is everybody wants to go build these crazy marketing campaigns. They say, are you going to buy a billboard? What about TV? What about a hockey board at the hockey arena? It's like, why don't we just go have a bonfire and burn the cash? That's not the way you do it. The way we've done it all along and the way we've seen the biggest returns is in-store tastings. If we can do an in-store tasting, we will take it all day. If we can do an out-of-home tasting, somebody's wedding, or there's a special event, or there's a grocery event, you go and do the tasting and you taste the people, and you get it at Loblaws, or you get it at Sobeys, or you get it at Walgreens, or wherever they're going to go. So that's number one. Number two is the temporary price reductions. So we're not going to do any BOGOs, buy one, get one free, where people get used to the brand being on a BOGO. So therefore you get the pantry shoppers, every other month, they just sit there and wait. They go buy 40 cases. They go home with them all on the discount, and then they wait another 2 months. They do the BOGO. We're not going to do that. We want to do temporary price reductions, ideally 6 a year. And then we want to do social media. So you geo-target the stores. We get some influencers. They go into the store. They show them putting it in the cart, showing them checking out, tasting the product, checking out the product, sharing it with their friends. We've ran some really successful campaigns too in the past where we did the Retro Red Cooler Challenge. We bought these coolers out of China for $30 each. They came to us. They were these cool steel premium coolers that look like they're from the 60s. And so every Thursday, if Maz and Greg went out and shared the photo of them drinking it with their friends, liked, commented, every time their friends did that on their channel, they got points. People with the most points on Thursday night win the red cooler. We would go live, talk about what we're doing, new flavors, new stores, auction off the red cooler. Off we went. For $30, we'd get 800 to 1,000 people visiting that live stream on a Thursday night, waiting to see whether or not they won their red cooler. So that's money well spent, and that's really where we see things. That's what we've succeeded at over 8 years. So that's our intent too in the U.S. I mean, when you move up into a bigger budget and you start drilling down into the DNA of your customers and everything, then that becomes a bit of a different hat.
Great. Where do you see the Crafty Elk brand going in the next 5 years?
So the Crafty Elk brand in the next 5 years, I see it being somewhere between 12 and 15 million case brand. I see it distributed across 10 to 15 states, possibly 20, maybe more. Just depends. Again, you don't want to take on more than you can't chew in terms of your cash flow. I've seen too many companies kind of take on 30 states, go out, and then it's this premium tequila drink that mixes and does all the stuff, and in another state, it's just a tequila bottle sitting on a shelf, dusted. So again, that making sure that a push pull comes along. So we really see ourselves being, year five, the EBITDA would be about 91 million USD. And what's interesting about brands that get acquired, which is where we're looking at, we're open to a trade sale or an exit in the form of maybe a reverse merger, or someone comes and buys the brand. Regardless the outcome, organics tend to get an increased buyout on the way out, and the reason they do is because they increase the incremental spend of the customer. And most people don't know this, but they did a study, and the average grocery store checkout of someone who bought an organic product and put it in their cart, they checked out at $44, and I think it was like 68 cents more than the average consumer. And so I always talk to restaurants and bars about this, because I'm like, make sure you put organic on your menu, because some of them just put Crafty Elk. And I'm like, why didn't you put organic on there? They're like, oh, I don't know anything about it. I'm like, organics increase the incremental spend. Well,
Mhm.
how? Well, when you go to the grocery store, do you start in the Coca-Cola, Red Bull, craft dinner aisle? Well, no, I start in the vegetable aisle just like everyone else. Right. Why do you think the grocery store does that? They do that because your executive suite as a customer is closed, and it opens it up, and you start putting the carrots and the broccoli, and you're going to do this dinner and you're feeling healthy. Then when you get to the middle aisle, you put they call the central aisle of the grocery store the morgue, because everything there is technically dead. So that's when you start putting those things in. Of course, you check out on the dessert aisle, but organics get a higher buyout on the way out. So when we look at our basically where we're going to be going, we're looking at a top line revenue of about $295 million on year five. We want to grow 100% year on year, and we believe we can do it. We believe that once we get into stores, this thing's going to fly. We're already seeing it here in Ontario. We sat down with Loblaws. Loblaws was like, basically it said, you can hand your deck in, you can call us. It doesn't mean anything. We have an international tasting team. So if we don't go out and taste your product and we don't believe it's innovative, you're not getting a call. And I said, oh, how'd you find our product? They said, we found you guys on a golf course up in Toronto. So the fact that that's coming from them, and we've got our tequila cans coming in our innovation, which is really, they loved it. They were like, you went black can, it looks really good, looks premium. Male drinkers are going to gravitate to that. Sports drinkers are going to gravitate to that. Right away, they were like, maybe an exclusive, right? So hopefully I've answered your question there.
No, you have. Greg, I guess last question is, why should anybody invest into the Crafty Elk brand?
You should invest into the Crafty Elk brand because you're only seeing 10% on our balance sheet. So when you look at the 800,000, you're only seeing 10% of what the brand can do. Basically right now, just being in these convenience stores for the last 8 weeks, we're pulling almost 15 cases per store per week with no marketing money. If you were to, this would be blue sky, unrealistic, but if you were to saturate every single liquor store in the US, which is 330,000, and you took 330,000 and multiplied it by 15 cases per store per week times 52 weeks in a year, you're going to come out of about $1.89 billion in sales. So I believe, we're organic, we're clean, we've got 8 years of sales, we have no debt. We've managed to do this all on $1.4 million. We've got a really great team. Not everyone can be hired. Some people are, very ex-PepsiCo CEOs and senior vice presidents and so forth. We've got a good team. I'm open to resourcefulness. I'm open to seeing innovation in marketing. I'm big on that. And I believe this is a solid track record of growth and management team and overall opportunity.
Great. Thanks again, Greg, for sitting down with us at the Deal Insider podcast. Appreciate your time.
Thanks, Maz. Have a great day.
You as well. Take care. Bye.